and welcome to the Fundamental Value podcast, hosted by Joshua Frank, co-founder and CEO of The Tie. On Fundamental Value, we speak with leading analysts, traditional finance and digital asset firms, and investigate how leading minds in the cryptocurrency space research, analyze, and quantify the value of digital assets. Quick disclaimer, this podcast was recorded and is being made available solely for informational purposes.
Today, I'm excited to be joined by Eric Rose, Head of Execution, and Drew Forman, Head of Cowen Digital at Cowen. Eric and Drew, it's great to have both of you guys on.
Thanks a lot for having us.
Yeah, thanks for having us.
We were having a little bit of technical difficulties earlier, everyone, so we had to switch from our normal recording software to Zoom. So it's not perfect. We apologize, but I promise our guests are perfect, and we're going to have a great time. So, let's get right into it. So, why don't we start with you, Drew, just because you're at the top of my screen. Can you provide a bit of a background on yourself and how you ended up co-leading digital asset efforts at Cowen? And then Eric, maybe you can follow up there.
Yeah, absolutely. I think the technical difficulties seem to be following me. We had an Ethereum podcast with Raoul Paul. My computer shut out right before it started, so I think you can blame me on this one. Something karmically. But Cowen Digital. So I was running the options team and derivatives team at Cowen. So equity options, risk arb, and cash ETF trading. Eric was running execution and trading on those products. And in pandemic during 2020, we finally got the go ahead after sort of years of pushing to trade Bitcoin options to start exploring crypto as an asset class. So we formed the Cowen Digital Working Group late 2020. That quickly and organically grew to 40 or 50 people at Cowen, spanning a lot of different groups. And then fast forward to today, we're live, a separate company still under the Cowen umbrella, Cowen Digital, and we've been live trading since the beginning of this year. And it's been about 18 months to 24 months of hard work. I'm so excited to be here.
Yeah, I would add that my background's similar to Drew's. 24 years of trading listed equity derivatives at various banks. Joined Cowen in 2017. Drew joined shortly thereafter. So heavy derivatives background, but always been involved in crypto personally for probably 5 or 6 years. And then we got into the Cowen Digital build out.
So how'd you guys actually get approval to go into crypto early? Because a lot of banks have been very slow and very hesitant. There are a number, and we don't need to throw names out there, that have said they've in crypto, and 4 or 5 years later, they're just trading Bitcoin options, and there's no custody, there's not much else. And so how are you able to do that? And how are you able to make such a strong move? Because I think a lot of others are citing regulatory concerns and other things. So how'd you guys get comfortable with, moving into crypto?
I think you see a lot of the other big banks really excited to make press releases about what they're thinking about doing, and really no one else has jumped into the space. Cowen really has a history of being a top 10 investment bank that sort of flies under the radar of these larger places, but also a real entrepreneurial spirit and teams like compliance and legal that are really business friendly and want to find solutions to being able to bring new products to market. So biotech in the early 2000s, Cowen's been a leader since then, SPACs, derivatives, and cannabis as well. And it's really just the ability to bring together so many different groups in such a complicated asset class to bring it to market. So what we did was we created a separate company, Cowen Digital, that's outside of the broker-dealer, because crypto is regulated by many different agencies in the US and internationally, has different regulatory environments. And that allowed us to really build this under an umbrella where it was regulatory compliant.
Are you just serving clients in the US, or are you serving clients globally?
No, we're fully international. So we're licensed in much of the US. We're pending our New York State BIT license, which hopefully we'll get soon. We're applied in Canada. We're able to trade for clients in the UK, and are exploring the rest of Europe and Asia as well.
And so what is Cowen Digital, right? I think we've kind of alluded to it a little bit, but what services are you guys providing specifically? And how are you differentiating versus a lot of your competitors, who I think are traditionally are the competitors of Cowen, are definitely not the competitors of Cowen Digital. So I'd love to kind of get, a little insight there.
Yeah. So, I mean, Cowen Digital really is effectively a mirror image of Cowen for what we do on the equity side. So, to say we're a crypto investment bank is probably a misnomer, but effectively trying to build the white glove service for execution, content, corporate access, investment banking, all the services that we provide for our equity customers and institutional investment managers in their decision process. So part of that is obviously the execution piece. So that's going to be spot trading. There'll be some creative ways to trade spot. That'll be borrow, lend, and shorting. That'll be swaps. That'll be derivatives. So traditional financial products for the digital space. Content, as I mentioned, we have a digital data scientist on our team who does great work. He does some deep dives. He does weekly notes, and he's building a fantastic data warehouse. And then our investment banking team, which is on the equity side, has taken 2 miners public, but is also looking at doing advisory work in the digital specific space. And then finally, for emerging hedge funds, capital introduction, which is a service that is sorely needed in the crypto space. Again, these are all services that Cowen does very well across our equity platform, and we're building those out specific to digital. And I don't think we've seen anybody really put all of those pieces together yet. I think there's some.
I didn't realize you guys were doing so much, so I have a lot of questions. I'm super excited to dive in. I mean, that's awesome. I mean, cap intro, absolutely sorely needed. I think corporate access is really interesting. I think a lot of the things that you're talking about are definitely needed in the space. So who do you? I mean, I guess there are people that are competitive within specific areas that you're focused on, right? Some folks are competitive on trading, some folks are competitive on banking, but no one seems to be. I would guess that the closest would have been Galaxy had the BitGo acquisition gone through, but given that it didn't, they're not in that area. But how many assets can you guys actually trade at this point, and how do you envision that expanding over time?
So right now we trade 28 tokens. We just listed 14 more, support for 14 more.
Can you go short on all of them?
Not yet. So the workflow for borrow, lend, and short is about 80% of the way done. Okay. So we're hoping to roll that out sometime in October, which will allow that. Again, the shorting of smaller cap tokens is not the easiest. It's not a direct translation.
That's why I asked.
Yeah, it's not a direct translation from traditional finance where you just call up another prime broker or another dealer and say, hey, can I borrow your ABC token? It'll be a little more difficult to source some of those. So I think we'll probably focus on Bitcoin and Ethereum and some of the large cap layer ones to start as being available to short. And then as the plumbing gets better, again, a lot of the retail focused holders of these smaller coins are kind of having problems right now. So it's an interesting build out.
How do you quantify institutional volume, or how do you think about that?
It's got to be more than a couple $1 million a day. So we'd like ideally there to be at least kind of $10 to $15 million of trading volume. But again, even measuring trading volume across globally exchanges is very hard to do. And because we can't access all that liquidity of 300 plus exchanges, and it's just the market structure is kind of a mess.
That was actually my next related question would be like, could I post an equity as collateral to take out a crypto loan?
So not yet. It's a little complicated just based on the different regulatory bodies regulating crypto and equities. However, we have been able to execute some interesting trades where clients have been able to sell Bitcoin through Cowen Digital, buy GBTC through Cowen Prime Brokerage, and custody the GBTC long through Cowen and traditional investment bank. And I think that, along with the cap intro and some of the research services, are products that the crypto natives haven't had access to.
And so one of the things which I thought was interesting, you guys have chose PolySign for custody, and I've actually been seeing their name pop up a lot recently. I think you guys also invested in them, if I'm not mistaken. So how did you think about, finding a custodian? Did you guys think about building your own custody solution, or were you from the get-go thinking about finding a custodian to partner with? So curious as to your thoughts there and how you got comfortable with somebody.
I think this is all super important. And if you look at the way traditional capital markets developed and matured, we were trying to plan for that. So if you look at like a lot of these retail platforms that you could say are our competitors, if you equate that to like the New York Stock Exchange, where you would deposit funds in the New York Stock Exchange, use the New York Stock Exchange app to trade with your New York Stock Exchange salesperson on the exchange, and then they would also custody your stocks, this would be a crazy concept. And that's sort of the workflow for some of these retail platforms without naming names. We think that the mature business
and more and issue you a credit card, and mint an NFT,
right?
And so yes, I'm with
keep
you.
it all, half of it in an omnibus wallet and on exchange with hot wallet risk. We wanted our customers to be able to have the ability to choose which custodian they trade in. So our workflow is custody agnostic in the sense we can trade into any wallet. We can trade into a self-custody wallet, we can trade into a Coinbase wallet, and we can trade into a PolySign standard custody wallet. What we did want to offer is an integrated solution for customers who wanted it with a platform that really holds the same values as Cowen. So one, top-notch security and custody platform. Two, institutional only. And standard custody, which is the DFS trust license company of PolySign, has all that. It has best-in-class MPC and HSM technology to be able to custody assets. They custody a range of assets and are able to add assets relatively easy to service our customers. So we led their Series B financing back in 2021. And then they had a really interesting opportunity to acquire MG Stover, which is the largest fund admin in the crypto space. And Cowen Digital, alongside Brevin Howard, GSR, and Soros, were able to help fund that acquisition. So we're essentially giving clients fully integrated fund admin, custody, and trading solutions. However, we're not only trading into standard custody wallets, and our customers can trade into multiple wallets. But we do have that integrated solution and some workflow synergies available for them.
And so, you guys actually already hit on part of what my next question was, which is how do you envision your product suite expanding over time? So curious to hear that, but also curious, you mentioned cap intro, really curious what the appetite you're seeing is from large institutions. Has it changed at all with the market? Obviously, I think broadly speaking, people have tightened their belts with the broader macro correction, right? I think it's not a crypto specific issue if I had to guess, but curious as to what you're seeing on the cap intro side. Obviously, all the funds in crypto want money, but do all of the real institutions want to give them money, and where are they kind of at?
So I'll let Drew. Why don't you handle the cap intro question, and then I'll handle the roadmap question after that.
Absolutely. I think when you looked at what we were originally trying to accomplish, our roadmap was mainly hedge funds and asset managers and traditional finance institutions. And this crypto winter has sort of slowed down their adoption directly, but all of them have working groups. So if you look at the 100 billion to multi-trillion-dollar asset managers, they're at all the conferences. They have working groups. They're vetting systems like Cowen Digital and PolySign, and their strategies will be deployed as this asset class grows. Hedge funds have been trading. They've been in and out. There's been a lot of spin outs of hedge funds and pods within hedge funds that have become crypto native, so they're active. And then there's this subset of the crypto natives who've been trading for years. They don't necessarily need anyone to trade, not someone like Cowen Digital to just execute. However, all of the other things that we're doing really resonates with them. So the fireside chats, the introductions to capital, the ability to utilize our data warehouse and our digital data scientist. And there's a real appetite from allocators to get into crypto. I think the direct allocations to tokens has slowed down, but they're all very involved in venture capital, and as part of venture capital, they're getting tokens, they're getting comfortable with the space. And through this crypto winter, there's been a lot of market neutral and quant hedge funds that have performed extremely well. So in a tape where almost every asset has gone down, if you look at this market, there's really been nowhere to hide, and especially if you're international with the currency moves. Some of these quant hedge funds have had stable returns throughout this cycle, and we're seeing interest to allocate, and especially allocate to managers with track records. So there is certainly an appetite from family offices, pensions, and endowments to allocate to some of the funds that we're putting in front of them. And we're choosy. We're not doing cap intro as a paid for service or anything. So we're really dealing with our partners that we think are good investments for these family offices, and we're seeing a lot of investment interest.
So is it mostly on the family office side then, where you're seeing like the readiness today to allocate?
Yeah, I would say the family offices are a little bit, especially the more sophisticated ones, are a little bit more nimble. But we're also seeing some of like the larger hedge fund names that you wouldn't think starting to dip their toes and allocate, and either bring managers in house or allocate to quant funds, because a lot of the backbone of that. The opportunity in the digital space is a lot more ripe than in the equity space where these funds have been trading.
And are
for
they allocating to other
dozens of
funds
years.
because it's hard for them to feel comfortable from a compliance point of view to be trading crypto themselves directly, or it's not?
Yeah, I
mandated?
think there's a general comfort with investing in funds. There's somewhat of a fear at times to investing your own balance sheet given taxes or accounting or just reputational risk to allocating to actual tokens. So
And are
I
you
think in
seeing
the
that on
coming
the
months we'll see
partners
that.
side or from with outside capital being allocated to other funds?
I think both. Certainly all of the founders who believe in crypto are allocating their own capital to this space. But I think you're also seeing LPs have an interest in diversifying.
And I would just add on to that, I think when you think about like the kind of initial investors institutionally in crypto, it's really been on the private side, whether it's picks and shovels and kind of infrastructure plays. And we've seen obviously, the valuations for private companies certainly gone up quite a bit. But those are the same allocators that are also now moving into the crypto space, but they want direct exposure, but a lot of it's not even directional exposure, to be perfectly honest, right? That hasn't come yet. That's going to be what we hope is the next level, right? Like right now, it's low vol market neutral strategies are certainly getting and attracting funds. Guys who are like, yeah, I'm 2x long, Ethereum and layer ones, not yet. And I think that'll come. I think as the product gets more robust in terms of assets to trade, more regulatory clarity, which we can obviously get into later as being one of the biggest blockers. I think you'll see more money go into directional strategies as opposed to just kind of financial products.
Yeah, and I'm curious on a lot of those market neutral quant related strategies. I mean, I assume that their capital there's capital constraints with a lot of them. No, I mean, like are they infinitely scalable strategies?
No, I think they're definitely not infinitely scalable, at least in this current market. And we've certainly talked with plenty of funds who talk about a limit. I'm not really liberty to say what that is, but like certain strategies may have a $200 million limit or a $500 million limit. But again, like you're talking about strategies that are basically arbitraging inefficiencies across the space. And whether those are MEV strategies or whether they're, liquidity pool staking and stablecoin, there is a cap right now. So again, that goes back to we need more assets to trade part of the category.
And so to the question that I was, I get it through two questions at once, then added a couple extras. So I apologize. It's super interesting, by the way. But product suite expansion. So we've talked about a lot, but where do you kind of see, the offering being 36 months from now?
Wow, 36 months.
I don't know, 36 months in crypto terms. So
yeah, I mean, 36 months in crypto terms is like next week. But bringing online, I think derivatives is actually going to be a really big lift. I think if you look at the market structure right now for derivatives, and I'm not talking about perpetual futures, more so on the option side. I think that's institutions need to be able to hedge, and they also just want to enjoy trading volatility products, and that market is not mature yet. You have Deribit, which only doesn't service any U.S. customers, and you have a lot of customers who are based in the U.S. You don't have a U.S. based exchange, so all the option trading for U.S. customers is on a bilateral OTC basis, right? And so that requires balance sheets. So your current crypto native service providers have their ecosphere is this big. When you look at like equity options and OTC structures that trade in traditional financial products, you have giant banks with giant balance sheets behind those. So that market, to me, is not mature yet. And I think that's a huge opportunity set for not only for us, but for others to get into. And that will be a significant driver. We're hoping to have that work stream up early next year. But that'll be a big one for us. Obviously, borrow, lend, and shorting, but that's already in the space. But even in the lending space, we just went through a whole mess, to be perfectly honest. And, we need some sanity for this product to remain, at an institutional level. So
I presume you guys are not doing fully uncollateralized loans without tracking other counterparties' balance sheets.
No, there'll be no uncollateralized loans coming from us. But it'll be a traditional matchbook type style. But again, over collateralized significantly, risk controls in place that will continuously monitor what's going on. And that's not to say that the other firms don't have risk controls, but clearly there was some things that were not working. So our goal is to bring that kind of working feel to it. So borrow, lend, derivatives. I think there are some interesting ways to go with DeFi. I'm not sure from an institutional level. I mean, maybe structured products on DeFi protocols could be something that would be interesting, offering investors the ability to generate returns from those protocols without actually giving them the access to it. NFTs. I'm not even sure where we go with that, but I'm sure there'll be a way for us to figure out how to.
Has anybody asked about NFT custody yet?
Yeah. Actually, yeah, I think that's certainly something our partners at Standard Custody are working on. Obviously, it's a different token type, but yeah, I think there are institutions who want to own NFTs. They're trading them. They have bots that trade them. They're going to want to custody them.
And so, my next question, which you alluded to with the regulatory piece, what are some of the difficulties or challenges that you've encountered so far? Building out your crypto operation, and then what are the challenges that your clients have faced in building out theirs?
I think, the biggest challenge is the lack of clarity in terms of who's regulating what. And we've dived head into wanting to be the sort of gold standard in regulation. We are not trading with New York customers until we have our New York State BIT license, which I think is not industry standard. We are getting all of our international licenses. We're working with our current regulators to make sure what we're doing is in a compliant way. I think when you get some clarity around the tax treatment and accounting, that will bring new entrants into the space. I think just the confusion on holding digital assets, even buy and hold on your balance sheet as an asset manager or as a corporation, is confusing. And once you see more clarity on that, you'll see more people come into the space. But right now, if you are in California, you can trade crypto without a license. In New York, the New York State has given out something like 20 BIT licenses in the last 10 years. I think they approve. What
is the time frame? I mean, I remember it was like 12 months a few years ago to get a BIT license. Is it worse now? Is it the same?
Yeah, I would say it's significantly worse. And I don't know that there is like a standard timeline. I think, the application is tens of thousands of pages, and all of these policies and procedures we have in place or we've built out new ones. So it's almost a good barrier to entry in terms of needing sort of institutional capabilities to come into the space. I don't know that they're going to approve many of the applications that are out there ever. We have multiple outside counsels that we're working with to advise us.
How many states are you guys working in today?
So we're licensed, is it 32, Eric? Or
32 states don't require an MTL. We have 5 additional MTLs, and New York State is the biggest one pending. But once we get through New York State, I think we'll be able to transact with approximately 90% of our institutional customer base.
What's second to New York in terms of needing an MTL? Like in terms of where the base is?
Florida, probably.
Yeah, I was going to guess.
Yeah. Florida needs an MTL, Puerto Rico, even Washington, D.C. So it is relatively confusing to try to figure out which states to apply, and we're hopefully going to have money transfer licenses in all 50. Although I think Hawaii is actually the most complicated, so it might be 49.
Right. For the 2 customers.
Sorry to all of our Hawaii-based listeners.
It's not our fault. Yeah, exactly. So it's super confusing, but I think the more regulatory clarity, we welcome it, and I think it'll bring more institutions into the space. If you look at outside of just the asset class as an investable asset class, you're just seeing a huge shift in brain power moving from Web 2 to Web 3. So a lot of these technologies are not just going to be tokens, they're going to be actual real world applications on the internet or gaming or ticketing or banking system. So you're going to have to see some of these tokens come in a compliant way to be able to be traded.
And so in terms of the client base that you have today at Cowen Digital, how much of that has come from Cowen versus new folks that haven't previously done business with Cowen in any regards? And is that surprising in any way?
Yeah, I think it's 50-50. I am surprised at the adoption by crypto natives, or I am surprised versus where we were a year ago. But now we're involved in the ecosystem. It's really interesting that we've made 4 or 5 other investments outside of PolySign, and it's just really great to be involved in the ability to get in on some of these deals because of what we can bring to the table, either partnerships or bringing family office relationships or ability to help them raise money. So I'm surprised at the crypto native adoption, and now I welcome it, and I really enjoy dealing with a lot of these potentially even more sophisticated investors than we are.
Yeah, and I would say that probably one of the things that surprised me the most in terms of this is maybe not appreciating how slow moving traditional large asset managers are. We certainly have
welcome to my life.
we've been in front of them. We made a lot of progress, and I would say, most of them are looking at digital in some way, right? It's very hard to come across an institution at this point that isn't doing the work, whether it's coming from a 25-year-old portfolio manager or analyst pushing it up to the top, or just seeing what's going on in the market. The informational calls that we have with customers at the very high level is enormous. So, not everybody is ready to onboard today because they have to change their funds, or they're an endowment, or they're a pension plan and they need state clarity. Like, there are a whole lot of roadblocks for some of these super large asset managers to onboard the product. On the flip side, I think the crypto native hedge funds that have surprised us because we've actually onboarded them not only for the digital side, but they're super happy to onboard with our prime side, so they can trade miners and they can trade equities. So it's actually, we've gotten a lot of inquiries of, hey, you trade digital, but you also trade equities. This is great. We can do both with you.
Yeah, it's amazing. It's as if crypto isn't the only financial product out there. I feel like sometimes we get stuck in this like trap and thinking that like crypto exists on its own. It's like, well, no, it's like a fraction of a percentage of the world's assets, right? So it's, we're still relatively small. That makes sense. It's actually interesting that you mentioned that, because we hear that all the time from our crypto native clients that they're absolutely trading, mining stocks. They want to trade Coinbase or anything else. That makes a ton of sense. Is there anything else specifically that's driving them to you guys beyond just equities? And like anything in particular? Is it the cap intro piece? Is it like what specifically?
It's all of it.
All right, fair enough.
Yeah, we call it the Cowen Bear Hug. Like we have, when you're a hedge fund at Cowen, like you have access to macro research, you have access to the best healthcare and pandemic advice. I think as crypto is maturing, it's becoming correlated to other assets. Whether it should be or not is to be determined. But because of that, I think they're also gravitating to everything else that Cowen can offer. So when we can put a dinner together where we have our head of Washington research, who has a pulse on the elections, as well as the crypto lobbyist and the crypto regulation, and have people from like the top hedge funds who understand macro paired with someone who's running a quant fund in crypto who can have access to this information, I think that's really interesting to them. So it's really the whole package. And every day we're learning and adding new things that we can do to help our clients.
And then I would also add in the content, which, I can't say enough positive things about David Kroger, our digital data scientist, but really trying to be thoughtful about the product in terms of understanding that we've all have an institutional background. We all kind of understand what we think institutional money managers are going to want to see in terms of the research product. So, our analysis we think is pretty good. And David pairs that off with fireside chats with executives from protocols, and we'll spend David will spend an hour with a customer talking about some NFT project because he has a lot of depth of knowledge across the space. But being able for customers to actually get somebody on the phone and bounce ideas off of them, you're not really getting that with other services out there. So the content is certainly a big piece. And then the banking side also, like access to venture capital deals and access to banking products. We actually have a special sits team that trades bankruptcy claims. They've been trading Mt. Gox bankruptcy claims for years. So there's really just a wide variety of ways that we can help. And I think that attracts people to us.
And so, as you guys may or may not know, we're in a bit of a bear market in crypto. And so has that impacted your strategy at all? Has it slowed you down in any way? Has it changed your direction at all? And has it slowed down onboarding a bit from where it was or where you anticipated it to be?
I think A lot of the bull markets. Someone said this quote yesterday. Bull markets are super forgiving, and bear markets aren't. So a lot of the activities that were happening, the uncollateralized lending, we were never going to do that. So I think this bear market's really allowing us to build the way we want to. And I think a lot of the standards that we have, the industry is coming to us. I think our clients are really asking for a trusted counterparty to lend to, and they want to lend to or borrow from, and they want this counterparty to have the backing of collateral. I think when you're only trading with crypto natives in a bear market, your assets may not be there when you need them to pay out. So in that respect, it's been great. It's allowed us to take a step back with a lot of the asset managers and really prep and plan them and win those mandates for when those large allocations come to market. But to be fair, it's certainly, it's an asset class priced in basis points, and lower dollars means, less trading is out there. And it certainly has shifted the accounts that are onboarding towards more of those quant and crypto native and sophisticated hedge funds. But we're long-term greedy. We're in this to build, and I think the bear market's a perfect time to be building, not just for us, but for a lot of the companies in the ecosystem.
Yeah, we've definitely seen a slowdown in some people's process. We've seen other people accelerate. Maybe we think that they have a similar view, like this is the best time to be doing it. Some people definitely got scared, but most of the people that we've spoken to haven't like cut off the product line. They're not like, oh, we were looking at this, but now we're not. And most of it is, we're just taking a pause. We're still doing our work. We're still doing our infrastructure build out, our DDQs. A lot of the stuff is still going on. It definitely slowed. Like it'd be, foolish to say that it hasn't. But the reality is, I think that when you're building an asset class for many years to come, this is an opportunity. Painful one for our personal accounts, but
you and all of our listeners. So, you guys have mentioned, this heavy data science approach that you've taken to, providing commentary around tokens. I'm curious as to how you think about education, because you mentioned 50% of the client base is crypto native. Their educational needs are very, very, very different. And they're more sophisticated. I mean, they're incredibly sophisticated, right? I mean, they're the ones that have been in the space for 5, 6, 7 years versus your more traditional clients. And so how do you actually strike a balance there? And where do you think there's more of a gap within the market?
Yeah, I'll take a quick stab at that. But I think that you're right, that we have multiple constituents to address. So like when we talk about our weekly notes, it's how weedy do we want to get in a particular token? Like that's going to appeal to a certain base, but we are trying to educate. And I think actually, and one of the things that we've learned over the last year and a half of the build out is I would say almost 70% of our job is education at this point, right? It's going into an asset manager. Drew and I have done presentations for entire asset management groups where they bring in 50 people internal to the fund to learn about digital assets. So I would say that education is a huge part of our job overall, not just what are tokens, but how to trade them, how to custody them, what is the infrastructure? And I think that education process will be going on for years to come now, because if people they haven't done the work, or they don't want to do the work and they need somebody to put it in front of them. So we have decks for, people who've never traded a coin before. We have a 30-page deck that we can put in front of somebody. And that goes through what is Bitcoin, what is Ethereum. And then the other decks that we have are a little more focused on execution, trading, and what do we actually do as a service. So it's a huge thing for us to think about. Our deep dives are not opinion pieces right now. They're actually education pieces. So we have 3 deep dives out, one on Polygon, one on Avalanche, and one on Ethereum. You don't see a buy recommendation and a price target on it. That may come down the road, but right now we're trying to build a library of information that our customers can access when they need to, and then they can get on the phone with David and follow up and have questions on it. So it's very heavy. Again, David can focus on super weedy stuff with the super smart crypto natives, and then sit there and tell somebody what is Bitcoin and what is Ethereum.
Yeah, I think it's really important. I think oftentimes the folks that are within the crypto industry get sucked down this rabbit hole, and we make up all these dumb terms for everything. Like everything is so much more complicated than it needs to be. And I think and that's the approach that we try to take at the company is like, okay, a hard fork is kind of like a dividend, right? Like a token burn is kind of like a stock buyback, right? And try to contextualize this information, because I think it's incredibly important, because by creating all of these weird terms and things that are just simple, right? Like all these on-chain metrics and all this different stuff. It's like, well, that can be explained in English. This is kind of like a 13F filing, right? This transaction we just saw on chain and things like that, right? I think we open the world to so many more folks that are kind of scared off by, all of this unnecessarily complex language.
Yeah, I agree. I think a lot of what you're seeing is tech or fintech PMs start to use valuation frameworks to look at these tokens, and we'll start to see building long short portfolios in the same way that we have long short portfolios in equities. But we're also learning a ton from our clients. I think we're never the smartest people in the room, and that's by design. So our clients are helping us, and frankly, they're helping each other. We've structured a lot of really interesting trades that we didn't even touch, where we've put together, a consortium of clients who are able to look at sophisticated trades and teach each other and be able to trade them within their network. So a lot of it is the network effects of being able to bring in people with diverse opinions and frankly diverse abilities to get trades on.
And so, you mentioned long short PMs moving in this space. And so my next question is around fundamentals. Certainly I can trade assets with Cowen, I can custody assets with Cowen, but do those assets, are they valuable? Or is there any fundamental behind them? Is there anything backing of it? And how do you guys think about fundamentals in the space, and how has your understanding changed over time?
I think the merge will be looked back on as a huge catalyst in the space. And I'm paraphrasing a lot of what Raoul Pal said on our recent podcast. We had him on with our Ethereum deep dive presentation, but it's going to give investors a massive asset class that's investable, that has sort of a risk-free rate in crypto. That's a staking yield for earning an asset. So like you said, earning dividends and stock buybacks, you'll potentially have the biggest or one of the biggest assets in the asset class earning a yield. And then you can sort of look at other protocols based on, their speed and throughput and different value lock metrics, and value them against each other. But
does that mean it's fundamental, just because it's yielding more of its own native token, which is also known as inflation? Does that mean it's fundamentally value? Is there a fundamental reason why somebody should hold this, or why the token should accrue value in the long run? Like, not asking specifically about ETH, but more broadly, how are you thinking about, like, how do you even start to think about valuing one of these assets as an investment as opposed to a trade? Because obviously a trade is very different from an investment.
Yeah, and I think that the initial trading is really viewed it as just another asset to trade, right? So a lot of the market neutral and arbitrage strategies. I do think that there is a valuation framework. It's actually one of the things that David's been building a.
You guys, by the way, are the best wingmen ever for David. Like, David owes both you guys drinks for life. Like, you just take him to a bar and just start,
We can't think highly enough of.
We've got him on a tough travel schedule, and he's he works for Starwood Points, so this is all he gets.
But yeah, so he's tasked with building out a data warehouse with which to really analyze the space differently. So we take discounted cash flow as the gospel in equities. Maybe that's not the gospel in digital assets, right? So again, I don't want to veer too much towards the pets.com and eyeballs and whatever measurement that we came up with to justify the internet bubble in 99. But there are different metrics with which to value tokens, and the network effect is something that is quantifiable to some degree. We're going to find out. I think that we're working on a valuation framework with which investors will be able to use as part of their investment thesis. Again, at some point, something has to generate revenue. How they end up doing that at some point, or just the network effect. Like, what is it worth to be part of somebody's network? There's no specific dollar transfer to be in a network, but there's value. So, that is something to fundamentally think about.
And there's definitely the store of value argument. There's the currency argument, and on top of that, there's the technology argument. So I am not sure where valuations stand. I'm a big believer in the asset class. I think we will start to see real cash flows accrue over time to token holders. What I am sure of is the things being built on these layer ones and layer two are real. And just as now with all of these Web 2 applications, you're not looking at what the underlying code of TikTok versus Instagram is. There's going to be real user experiences, and those are going to be blockchain based. And from that, we're going to see the asset class emerge as highly investable.
So where do you see real value in crypto today? Like, what has some fundamental underlying value? And does it even matter if that exists today or not?
I mean, obviously ETH is going to be the biggest one for us to focus on. I think that it needs to get faster before it's really usable. Like, obviously we like, Solana is a fast chain, but sometimes goes down. Avalanche, excellent technology. So I do think that these are core investment in your portfolio, right? Is to have layer ones that are the ones that are, effectively the internet, right? You're owning the internet, and there's going to be multiple winners there. So I wouldn't want to pick one. I'm not going to go out on a limb and say one's better than the other. There are better aspects.
So what do you think about the fat protocol thesis, which is kind of what you're alluding to there, right? Which is the idea, with the internet, the value didn't accrue to the HTTPS layer. It accrued to AOL, and it accrued to Apple and Google and all the things that were built on top of it. Do you guys think that the value is more going to accrue on the protocol level with your Ethereum and your Avalanches, or do you think it accrues more on the application layer in the long run?
Go ahead, Drew.
I think there's an argument for both. And to the analogy,
these aren't trick questions, by the way.
No,
I think, look, I'm a big believer in Ethereum. I think it can be, a large portion of the market. I think the amount being built on it is great. And I think the tokenomics, like you said, the fact that we're going to get an asset that's potentially deflationary and pays, accrues cash to token holders, I think is massive. That will take more adoption. And I think there are a ton of layer two scaling solutions that, we'll see the fruits of those labors. In terms of like the other layer ones, like if you look at, now like you're saying, Google and Facebook, when the internet first started, it was Ask Jeeves and, Netscape and all of these companies that don't exist today. So it may be the case that none of the protocols that we're talking about now end up being the winners, but I do think the asset class is over time going to accrue value, and we'll see how that develops.
But I also think that the premise that value will accrue not just to the content creators, obviously, or the protocols that are built on it, but I do think that it'll be more evenly distributed than it currently is, right? Obviously, HTTPS doesn't generate any revenue, and Amazon takes all of our dollars. So I think there'll be a blend there between the layer ones and the protocols, and then the users. I think the users will be generating value. Your use of yourself will have value, and I think that's the third piece there, or the third premise of Web3.
And so, what has surprised you most during this winter about the market, about digital assets, anything crypto related?
I'll take a stab at this. I think that the speed with which the asset class corrected itself following some of the turmoil back in May, June was kind of stunning. I've been in markets for a while, and I've seen some really interesting things over the last 25 years. But the speed with which that things unraveled back in May, June was pretty epic. But the fact that came through it, I think, was actually the best part of that is again, protocols didn't fail. Like, the system worked. We cleaned up the bad actors, and we're ready to move on. And I also think that had this happened when there was more widespread adoption of crypto within the financial system, the effects of that could have been way, way, way more. And so, I was surprised with the speed with which it happened, pleasantly surprised that we're able to kind of come together and come out of that, hopefully, and, that we're still here to do this. So definitely surprised by that. I'm also a little surprised by the slower adoption from traditional finance. Like you said it early on, why aren't more funds going to this alpha generation that can be done here? Why are they still stuck in TradFi? There's a place for every asset in somebody's portfolio. I'm just surprised there hasn't been more adoption.
Yeah, and I think, to add to that, like, it's really a great community. Even in the upturn and the downturn, you asked the first question, I think, who are our competitors, and I would say that no one is a pure competitor. In derivatives, I can tell you our 49 competitors, and we literally go head to head with them for a pool of assets and a pool of trading commissions. And in digital, like, all of our competitors, so-called competitors, are potentially trading partners and lending partners, and there's really just a community around wanting this asset class to work, because I think that will lift up everybody. So we're super early. I think this can work for a lot of different companies, and it's exciting to just be on a call with anyone, be it someone offering sell side services or buy side services or an NFT company, and 5 minutes into a call, finding ways to work together.
And I loved all those answers, by the way. I thought they were all great. I may take those if anybody asks me the question in the future. But I really like the point that you brought up, Eric, which was the fact that this asset class crashed so fast. And that actually really surprised me as well, thinking back on it, right? Like, we've been talking about the market becoming more institutional, but does that speak to the fact that crypto is still majority retail? Do you think that's the reason for that, or?
Well, listen, if you think, the 3AC unwind was, almost perfectly analogous to the Archegos situation in equities, right? And you had a firm that went outside of crypto and borrowed in the traditional sense from as many lenders as they could possibly get, right? That's a TradFi concept of massive over leverage. So I don't think that that retail side of it really was as much of effect as smaller institutions clamoring over themselves to get a piece of the action and then finding themselves on the wrong side of it. And again, some of them weren't robust, some of them weren't well risk managed. Everybody wanted a piece of it, and they all got burned by it. So that, to me, that's not a retail phenomenon at all. That's pure institutional greed right there.
Yeah, and it is an interesting asset class that was formed with retail, and then you just had like an explosive Fed. You had Stimmy, you had aggressive people with nothing to gamble on, and Dogecoin and Shiba Inu and Twitter, and it was created the perfect storm of a crazy bull market, and then a delevering that we haven't seen before, which probably overshot or may still be overshooting. But the system worked like it should. Ethereum hasn't gone down ever. Bitcoin has never gone down. And that part of it's exciting.
And so do you think the asset class becomes less volatile? I think obviously it does over time and in the very long run, but do you think in the next 12 months it becomes less volatile, or you think it remains to be volatile? And do you think that this changes at all behavior of participants in the market being washed out on over leveraged trades, or will that just continue?
I'm sure the markets will always find ways to give leverage to those who want it. That's just kind of the history of Wall Street is littered with over leverage. I do think that we'll see some more adults in the room, I hope, in terms of just managing that. And, I think at the end of the day, liquidity is really going to be the driver of volatility. It was 2 years ago, you'd have a Saturday night and Bitcoin would be down 20% on a margin liquidation on Binance. Like, you don't really see that anymore. And why is that? Because we have institutional market players who've moved into the market making space and who are making markets on all these different exchanges. And so the ability to arbitrage one exchange's liquidation, instantly happens. So that 20% drawdown now becomes a 5% drawdown or a 3% drawdown. So just institutionalization of liquidity has helped to dampen volatility. And I think that as more participants come in, more liquidity will come in, and I think volatility will naturally go lower because of that. I do think there are exogenous events out there that could cause significant dislocations of asset prices. But in terms of just day-to-day, volatility of the asset class, it should trend lower over time as it is adopted by more players.
And so two final questions. This one I wanted to ask earlier, but I forgot to, which is risk management in crypto. How, as you think about portfolio risk or even risk for you guys as you're, on the principal side, can you bring over risk management frameworks from the equity side or from the derivative side into crypto, or you need to build crypto specific risk frameworks? Like, how are you thinking about it? More on the, obviously there's the smart contract risk side, but I'm thinking more on like the market risk side.
I think you definitely can. I mean, we cut our teeth the last 5 years on small cap biotech and PDUFA dates, and 50% moves that were priced in all the time. So we're akin to these types of moves. What I would say is the space needs more development for institutional tools. We have surprisingly had to build a lot of the things we're looking at in-house. So all of our internal OMS for managing cash flows and collateral, that's all been built in-house. The reason we invested in PolySign is a lot of their technology had to be built from scratch. That's why the company was started. Arthur Brito, who founded the Ripple Ledger, wanted a way to custody some of his own assets, and there wasn't anything great out there. And we invested in a lending platform called Digital Prime, which is helping us build out all of our lending infrastructure. And there's a really robust infrastructure in equities securities finance, but there's really nothing off the shelf that firms can use, and everyone's building in-house. So yes, over the next 12 to 24 months, we're going to see a lot of products that are out there able to use for people to manage risk. And I think it will be bringing in a lot of what we use and have learned from traditional finance. But frankly, there's not a ton out there, and there is a need for the institutionalization of that.
Yeah, and just to layer on that, at the end of the day, it's another asset, and it trades and it's volatile, and it may be more volatile than other assets, but you can still manage risk around that as long as you have the tools to measure the volatility and the real time measurement. So the risk policies that we have in place certainly had their blueprint in our equity and our fixed income risk management policies, because that's how we manage risk across the firm. So whether or not we apply more stringent, profiles to these assets, yeah, we do, right? But it's still going to be, hey, what is the most pain tolerance we're willing to take on a move, and what is that percentage move, and that's how we work backwards. So I think the tools are there. They need to get more robust, and they certainly need to be more adopted across the space.
So my final question: what is your hottest take right now?
I'll let you. You're going to pitch some.
No, I'm going to tell you something. No,
this is your opportunity to pitch the microcap in your PA. So.
No, no, I would never pitch Phantom. But no, I think a lot of people have been looking for DeFi gaming to really take the next leg up for crypto, and I just don't necessarily see that occurring as fast as people want. So that's a little cold water on a negative theory that it's taking a little bit longer. I do think that something like the Solana phone, I think is really interesting in terms of addressing the 7 billion mobile users, which I think is really the future of where we need to go. We need usable use cases for blockchain. And if you can figure out how to get a blockchain operating system up there and get it in everybody's hands and get that screen in front of them, I think there's such a huge uplift to that. And I think it's going to take a little bit longer, and I think it'll probably take a little bit longer than most people want.
When's your Solana phone being delivered?
I can't tell you that. But I think in concept, I think that it's really speaks to where we're going to go.
What about you, Drew?
Yeah, I mean, in terms of how to invest, I would say go big, like heavily weight the top 5 to 10 layer ones. I think that they're going to all outperform together. I'm a big believer that Ethereum going proof of stake is going to work and really lift up this asset class. Unfortunately, we have to deal with the macro tape, and crypto is not going to rally until we sort of get a handle around interest rates and see a rise in some of these other asset classes. And on the private side, we just met with a really interesting security company today. I think that will be the biggest space going forward, is figuring out ahead of time a lot of the flaws of some of these protocols and systems, analyzing trades. That space is only growing, and there are a few players now. I think there will be a lot of winners in that space. So from the VC side, I would say that infrastructure play is going to be huge.
Cool. Well, this was awesome. I learned a ton, as I'm sure others did. And, hopefully everyone listening wants to learn more about you guys, wants to reach out. So where can they find you guys and find out more about the offerings?
Eric, give them your home address.
You can go to the Cowen website. Well, it may take a couple of clicks to get there. But contact information for the Cowen Digital team is on the cowen.com website.
Yeah,
we'll drop that in the link.
We're both on LinkedIn, and would love to get institutional players added to our distribution and start a conversation.
Awesome. Well, this was great, guys. I learned a lot. I appreciate having you guys on, and thanks for coming on.
Thanks a lot, Josh.
Thanks, Josh. It was good to see you. Take care.